It's For Your Money Wednesday, and if you're thinking about buying a house, you might be confused which mortgage to get, a fixed rate or adjustable rate mortgage.
And some might think in today's rate environment, a fixed rate mortgage is the only option, but that's not necessarily true. According to Forum Credit Union's Andy Mattingly, he joins us now to talk about the differences. Good afternoon to you. So why are people so fearful of an adjustable rate mortgage or an ARM?
Well, I think a lot of it is just a lack of knowledge, because they feel like that if you're an adjustable rate mortgage, that rate could go up at any time, and then their payment's going to go up, and they won't be able to afford their payment. So they get very fearful of those types of loans.
So go ahead and go through the benefits of an ARM.
Well, an ARM, a lot of times the rate's going to be lower, which a lower rate then means you get a lower monthly payment. And the other thing is, ARMs usually have a fixed period of time, so you can get 7-10 years of that time that rate's going to be fixed, so you don't have to worry about the rate going up all the time.
What are some other things you maybe need to understand or make sure you understand before you get an ARM loan?
Yeah, it's really important to understand how much the loan can go up at each adjustment period. So how long is that adjustment period, then how much can it go up, and then how much can it go up over the life of the loan. Those are some important things to know.
So any other things that people should know about ARM loans?
It's really important to understand that each lender has different things. So you can't go to one lender and get all the information and then just go shop rates, because every lender is going to do it differently. So you wouldn't want to find out that in one loan it could go up 5% and another loan it could go up 7%. That's a big difference. So you need to understand all of those intricacies of each loan that you're looking at.
And talk a little bit about the timing. When is the best time you want to try this option?
Well, if you know that you're going to leave your house in 7 or 10 years, whatever that fixed term is, that's a good time to do an ARM loan, because you know you're going to be out of it before the rates ever are going to adjust.
Some might say see a fixed rate loan as the better option. Why would that be?
If you know you're buying your last house you're ever going to buy and you're going to stay in it for a long time, that's probably a good time. Or if you really just don't want to take the risk of your payment going up, you feel like you can't afford it, then you want to go the fixed route.
And how much lower might the rate be on an ARM versus a fixed rate? What could that difference be?
Usually it's 0.5 to 0.75%, maybe even 1%. And on a $200,000 loan, that's $100 less a month in payment. So the bigger house you buy, you can see how much more you can save in a payment there.
You can see that difference
Yes.
every month. All right,
Yes.
Andy, thank you so much for coming in
Thank you.
today.
Indeed, thank you.
All right, we do have new information this noon.